Focus. But before we get to that, just quickly to reports about the mortgage crunch and whether it might be about to begin. There's been a lot of speculation about what might happen when the long stretch of historically low interest rates starts to end, given the enormous increases in property values in the last 5 to 6 years, and also that so many people are up to their eyeballs in debt. Well, is it starting to happen? This morning, we're told, up to 1 million Australian households could be in danger of missing mortgage repayments by September. That does seem awfully soon. Let's talk to Martin North. He is from Digital Finance Analytics. He's one of the people who's done some of this research. Good morning.
Hello, Cassie.
Now, where does the million households figure come from? How are we breaking that down?
Okay, so it's based on our household survey. So we talk to households all the time about their cash flow, looking at money in, money out. And what we're saying is that there are currently around 970,000 households of the 3-point-something million owner-occupied mortgage borrowers who are effectively right on the edge at the moment. So we say they're in mortgage stress simply because they don't really balance their inputs and outputs. In fact, very close to the wind or underwater. And they're getting by putting more on credit cards, cutting back on spending, raiding deposits. Now, of course, as interest rates tick up, and we think they probably will tick up later in the year simply because of international funding pressures, that is going to add a little bit more pressure, and it's just going to move the dial up to close to 1 million households. It doesn't mean they're all going to default, but it means that they are going to have significant pressures on the budgets and will have to do a lot of rebalancing and dialing back. And some of them off the back of that could end up defaulting. About 50,000 potentially may default over the next 12 months.
Wow, that's still a lot. It's up to 1 million in stress, 50,000 defaulting. Where do you expect those hotspots to be? I mean, do we have any kind of geographical analysis of that? I mean, in Sydney, we like to think we're the worst off in the country. Do you think that's true?
Well, there's certainly some hot spots. In fact, it's across the whole of the country. But let's take New South Wales and give you a few examples. So typically, you would expect people over in the west around Campbelltown and around there to be close to the wind. They have been, as long as I can remember, to be frank, it's always a bit of an issue. But we've also seen hot spots, for example, in the younger, more affluent household areas around Bondi or even up in places like Mossman, who they bought apartments, for example, on very big mortgages. They've got quite big incomes, but their incomes have actually not been growing, and those mortgages are huge, and the other costs of living are growing, so they're under pressure. Another example will be up on the Central Coast or down in Sutherland. They're more mature, older households, but again, it's an income expenditure mortgage conundrum. Big mortgages, income's flat, cost of living going up, and you can list childcare and you can list school fees, electricity bills,
energy bills. Gosh,
the whole lot, and even health costs. Everything is going up except incomes.
Yeah. So I guess, we've already seen some movement on this. Macquarie Bank's joined a few others this week. It's not the big four, though.
Not yet, no. So it's been interesting. So the reason, there are two sets of reasons why we're seeing this pressure on margins at the banks. The first is that the international funding costs have gone up, and that's partly because of the Fed's moves in the US. It's partly to do with the international capital markets and how they're going, because around the world, effectively, quantitative easing is being dialed back. And that's putting pressure on the benchmark rates here in Australia. It's gone up around 30 basis points from February. So that's quite a lot. The other is that there's a lack of confidence now in the local finance sector here from international investors, partly because of the Royal Commission, partly because of all of the dirty linen that got washed there. And those two factors together have made it a little more complicated for banks to be able to then fund their book. And around 30% of that funding has to be other than deposits. So that's either internationally or local investors. And now those investors are saying they want a little more. Now, the big guys have so far not followed the small guys, and they've got a little bit more wriggle room perhaps, but the pressures are really, really strong. And there's something else that's going on, and that is that some of the majors are also deeply discounting new loans to try and attract refinancing deals from other places because they're still fixated on growing their loan book. So you've got this dual contention between effectively funding costs going up and also deep discounting for new loans. The net effect of all that is that the majors will definitely hike their mortgage rates for their back book.
Right. So the banks are doing it tough, you're saying, Martin. My eyes are just watering with tears for them. I can't, I'm overwhelmed with emotion. We're talking with Martin North. He's the principal analyst with Digital Finance Analytics. Okay, so the banks, they're not going to move, though, on this until they've got this end of financial year reporting season out of the way, because it's going to be a bit embarrassing when, once again, we see how much money they've made and then they're putting the rates up at the same time.
Well, some of last time around reported margin pressure. And, you're touching on the critical question now. Will the banks effectively reduce the payouts to their shareholders? And, a lot of those are international investors. There are some in Australia, of course, as well, but a lot of it's international money flowing out the country. Or is it time for the investor community to take some of the pain rather than the poor old mortgage holder? Because it always seems to me that the mortgage holder gets hit over the head by a 4x2 very often in these situations. It's a real interesting conundrum. The real issue is, though, we're still drowning in debt and we're still seeing debt growing faster than incomes. So we haven't actually solved the fundamental root cause problem, which is too much debt. So my own view is that we should actually be changing direction and not expecting the banks to continue to grow their loan book. That would also give them a little more latitude in terms of managing the interest rates for the existing borrowers at the moment. But there's a real trade-off question here, and I still suspect that investors will end up with a better share rather than borrowers.
Okay. So if what we're speculating here does come true, and by September we see the standard variable rate increase by just 10 basis point, 0.1%. That, you say, for an example of a Sydney household, the average with a $750,000 mortgage, that'll mean $60 a month, which I guess seems small. But as you say, if these pressures of all those added costs and low increases in wage growth, then that's going to start to bite. When you add maybe one or two investment properties, it could get a bit tougher.
Yeah, well, certainly there are other surveys out there that have said that there's around 30% of households with mortgages who would not be able to cope with an additional $100 a month. That would actually tip them over the edge completely. And my data sort of supports that too. People are really, really close to the edge. But what they're doing at the moment is three things. They're dialing back on spending, so that's why the retail momentum is ebbing. I think that will continue. They're raiding their savings where they've got them, and they're putting more on credit cards. None of those are sustainable strategies. And that's my real concern, that, the rates might go up, but it's what happens 6 months, 12 months, 18 months down the track, because I can't see an easy way out, because incomes, I don't think, are going to start correcting up anytime soon.
Already I've seen a lot of properties around the place, suburbs where I live, that aren't moving in with the incredible speed that they were 6 months ago. There's a few that have been on the market that I drive past every day for weeks and weeks now. So I wonder what's ahead of us. And if you aren't in the property ownership position, this is also possibly going to have a flow-on effect for rents as well. Which way do you think rents would go?
Well, rents have traditionally always tracked income rather than home prices. So I'm not expecting rentals to sort of kick up dramatically. But the fact is that we've got a greater proportion of households in the rental sector in stress. So in other words, with cash flow issues, they're sitting at about 40% rather than the 30% of owner occupied. So this sector is also an issue. We have a housing mess in Australia because effectively the cost of housing, whether you're renting or whether you're borrowing, is way too high, and that's years of failed policy, in my view.
It does seem to be the case. Thank you very much for explaining this to us and for your research, Martin.
Good to talk to you.
Martin North, Principal Analyst with Digital Finance Analytics, with that prediction that by September this year, up to 1 million Australian households will be struggling with their mortgage repayments, given the increases likely in interest rates across the board. And up to 50,000 of them by the end of 12 months could be in default. Rather depressing news.